If you don't know where to begin, better ask when.
Shane, very good to see you. Today we're going to talk about how to reduce taxes in your portfolio. Everybody has probably heard about asset allocation before, but perhaps just as important is asset location, where you keep your assets in a tax-advantaged account or a traditional brokerage account can significantly lower the tax bite in your portfolio. So let's start high level. Can you please talk through the tax benefits of a traditional and a Roth IRA and how each has its own tax advantage?
Sure. So they're kind of direct opposites. You use a traditional IRA maybe in the years when you're trying to keep your taxable income low, because you can take the deduction for the money that you put into the traditional IRA or the 401k. They're kind of cut from the same cloth. Take the deduction for that and lower your overall income. And then you get to defer all the growth, all the tax on all the growth of those dollars for the next 10, 20, 30, 40 years, whatever that might be, and allow that money to grow without paying any tax. But the thing you have to make sure you pay attention to with a traditional IRA is it's taxable on the back end. So when those dollars come out, it's completely taxable to you as ordinary income, as if you just made it from a job or elsewhere. And that can be problematic later in life for things like tax on Social Security, and in other areas it can drive up taxes across the board. So the Roth is kind of the complete opposite. No deduction. There's none of this trying to reduce our income for the year element in a Roth. But every dollar you put in is then tax-free. It can grow tax-free and come back out tax-free as long as you follow the rules set forth by the IRS. And that tax-free dollar later in life can be so important because it won't drive up things like tax on your Social Security. It won't drive up your Medicare costs and the like, especially once you get into later in life and into retirement.
Yeah, well said. All right, next, consider tax loss harvesting. Can you explain how this works, please?
Yeah, this is an interesting concept. So let's say you have a non-qualified account. It's typically where this is talked about the most. Let's say you have a pool of stocks that are all highly appreciated and you want to sell them for a large gain. When you do that, of course, you're going to trigger some long-term capital gains tax. But let's say you also have a pool of other stocks or other tools that are depressed at the moment. For some reason, they're down. So what you could consider doing is selling the ones that are up and the ones that are down. Take a loss on paper with the ones that are down. That will help kind of offset some of the gains from the ones that were up. And then, of course, put those dollars right back in and get them back to work again so that they're still working, but you took a loss on paper to help offset some of those gains. Can be a great tool to help you liquidate some highly appreciated non-qualified assets.
Right. All right. So now let's drill down into asset location. Dividends and other cash distributions are typically taxable in the year that you receive them. To minimize your tax burden on dividends, consider where you hold your investments. What do we need to know?
Well, the thing I always think about when it comes to this sort of topic is what's 1099able and what's not. So like a lot of money in things at the bank or in CDs are 1099able. Or every year you're going to get a 1099 for the income. Now, if you put money into other places like into a Roth or into an IRA where the tax is deferred, you don't pay the tax on it every single year. You only pay it when you sell it for a gain, for example, on like a non-qualified stock account, or when you take it out in the form of income in a traditional IRA, or if you follow the rules of the Roth, it might all be completely tax-free. So you want to make sure you consider those types of accounts because it really matters as to how much tax you pay.
Right. And so next, take advantage of long-term capital gains tax rates. With strategic and very advanced planning, there is a potential for a 0% tax rate.
There definitely is. I mean, you can get yourself to where you have no tax in retirement or later in life by having all of your income streams coming from things that are tax-free and the like. But the one thing you want to make sure you pay attention to when it comes to capital gains is you want to use those brackets to your advantage as well, because there's two brackets, 20 and 15, and those are a lot lower typically than the income tax brackets that you're going to find yourself in. So those might be a great place, a great tool or strategy to help control the taxation that comes your way later in life.
Right. And talking this through with you, Shane, it becomes apparent that proactive planning is key. Start thinking about this now. So if somebody wants to talk to you more about tax diversification and how they can save money, reduce the taxes in their portfolio, how can they get a hold of you?
Best way to reach us is online or via phone here at the office. Our website is winstonandcompanies.com. You can schedule a visit right on there or call us here at the office, 602-456-1928.
Great. Shane, thank you.
Thanks, Erin.
Got a plan for your retirement? you know it's just down the road. But if you don't know where to begin, better ask when.